counting down the days to RebelCon, and virtual passes are now available at an early bird discount of $200 off the normal ticket price. This virtual pass gets you live access to all general sessions with our expert keynote speakers, as well as links to view the sessions later. This deal will end soon, so get your RebelCon virtual passes now. Hit the QR code for more info or visit rebelcon.marketrebellion.com.
And happy Friday, Market Rebels. And it is a happy Friday if you're bullish, because as I'm watching the markets go into the close here, it looks like we have what's actually called a Maribozu close, which is a shaved candle. Because it's green, it means that it closed right there at the high, or at least pretty close. So again, showing some pretty good strength here. This is about our 7th or 8th candle off of the 100-day moving average for the SPY. So still seems to have some pretty good momentum. So certainly looking positive, but we'll have to see what next week brings, because it's always a new slate at the start of the week. Anything can happen. And that's why you have to learn your options and how to hedge, roll, and morph your positions. And one of the things that I like to teach whenever we're talking about vertical spreads, which we've been talking about for the past couple of weeks in various forms, is a way of understanding the philosophy of a debit spread versus a credit spread. And that in itself can be helpful for new traders, but it can also shed some light on some positions and break-even points and things like that, which we'll talk about in just a moment. So the idea here is what I sometimes call cheap or chicken. And again, it's really just a kind of an interesting way of looking at the philosophies of debit spreads or credit spreads, because they do tend to throw traders. People get hung up on the word credit and think that that is somehow better. But as you're going to find out, and I think we're back, everyone. I'm so sorry for that. I don't know what happened. I had some kind of a technological failure here, but I hope everybody is now getting a signal. So anyway, back to the story here is that this idea of cheaper chicken is just kind of a fun way of understanding the philosophy of the two different types of spreads between a debit spread and a credit spread. So, all right, there it goes. I'm so sorry. I don't know what the technology issue is. So once again, it will also help you to understand why it's a debit or a credit. And once you do that, it's also going to give you some really good insights into some of the more advanced strategies, things like butterflies and condors, short iron condors, and help you to figure out break-even points and things like that, which we'll look at an example at the end. So to do this, one of the things that you have to understand is a pricing principle that we covered back in May. One of many pricing principles out there, and this one says that lower strike calls must be more valuable, and that means more valuable than the higher strikes. So if you're looking at a $100 call compared to a 105, we know that the $100 strike must be worth more money. That's assuming the same underlying and the same time to expiration. The reason is fairly simple. It gives you the right to pay less for the shares, ability to go in the money much sooner. And because it's a benefit, you have to pay for it. They are going to trade for more money. Now, the corollary to that is that higher strike puts must be worth more money for really the opposite reason. So a put gives you the right to sell your shares. So all things being equal, you'd rather sell your shares for a higher price. So as we move to higher strikes in the puts, they are going to become more valuable. So, let's take a look at an example where we have the $100 call versus the 105. Again, we know that the $100 call must be more expensive, And the $100 put, if we look at the 100 put versus the 105 put, we know that the 105 put must be worth more money. All right, this is an absolute must. It's not a maybe, because arbitrage is going to force this to happen. So it's an important pricing principle. So now let's start off with a debit spread. Let's say that you buy the $100 call and you spend 10, or at least that would be the price in the open market. But then you sell the 105 call and collect 7. And because of that, you would have what we call a net debit of 3. That's just the net between those two cash flows. Now, the thing to understand, this is one of the most important points, is that the $100 call, the lower strike, is what's we call the controlling option. That's what's really dictating the nature of this strategy. So sometimes traders who get confused with spreads, don't let it confuse you. Just look at the controlling option. It's a call. It's the lower strike call. What are you doing with it? You're buying it. What's your outlook when you're buying a call? It's bullish. This is a bullish outlook. It has to be, because you are in possession of the more valuable strike. Okay, so again, the thing to always fall back on, buying a call is bullish, and therefore buying a call spread is bullish. So in this case, the sale of the 105 call for 7 was to reduce the cost of the $100 call. So if you are doing a debit spread, whether it's with calls or puts, you can think of it as a cheap strategy. This is where the cheap comes from, in the cheaper chicken. You're just trying to reduce the cost. So in this example, if we buy the 100 and sell the 105 for a net of 3, this would be our risk graph. There's our maximum loss of 3. There's our max gain of 2. Now, if you just look at this left-hand side, right, there's your long call. There's the long 100 call by itself. And if you just held that call by itself, you would have unlimited potential gains, but it would cost you $10. So the sale of the 105, which is what created this little flat blue line over here, was done to knock this price down from 10 to 3. And for that, you get some trade-offs, right? So let's take a look at the trade-offs. Here is the vertical spread in blue. Here's the long call in red. So you can see that it would have cost you 10, but because we entered the spread and collected 7, we've reduced the cost from 10 to 3. But the trade-off is we had to give up some gains. Not all of them, but all of the gains above this crossover point. So again, this is what we might call the cheap strategy, and it applies to any debit spread. You are simply trying to reduce the cost. Now let's flip over to the credit spread. Let's say that you buy the $100 put, you spend, maybe it's trading for 8, and you sell the 105 put trading for 10. Okay, notice what the controlling option is here. It's the higher strike option, right? This is going to be a net credit of 2. You collected 10, you spent 8. So again, the 105 put is what we would call the controlling option. It's the higher strike put. That's what's dictating the nature of this strategy. In this case, the purchase of the lower strike put is to reduce the risk, not to reduce the cost, but to reduce the risk. So whenever you are using a credit spread, whether it's with calls or puts, you can think of it as the chicken strategy. You're really afraid to sell this put by itself, what we would call a naked put. Yeah, sure, you'd love to collect the entire $8, but you're going, you know what, I would have so much downside risk. If we sold the 105 is what you'd like to do and to collect this full $10, but then you'd have all of this downside risk. And so you're saying, instead of doing that, let me spring for an insurance policy and buy this 100 put. So again, it's to reduce the risk. So if we look at that spread, it's going to look just like the previous one. It has a bullish bias. Why? Because you are selling a put. Selling a put is bullish. So there's your max gain of 2, max loss of 3. Now, if we look at just the short 105 put by itself, this is what it would look like. And we would have the ability to continue, we would have the potential losses all the way down to a stock price of 0. And so that's the part that we're going, I'm not so sure about this. Yes, we would collect 10, but I don't like the idea of having this unlimited downside. So what do? We buy the 100 put, and that's what creates this flattened off portion over here, but that is to reduce the risk. Right? So here's a comparison of them. There's the short 105 call. There's the $10. But we're looking at this and going, I don't like all of this downside risk. So what are we going to do? We're going to give up some gains, and that's our chicken strategy. We're willing to give up some of the gains in exchange for reducing the risk. All right, so that's really the essence behind a debit spread and a credit spread. You're not getting a credit because somebody is just paying you to be nice. They're not paying you to take an asset. It's because you're taking a risk. And that's important whenever you start hedging, rolling, and morphing positions, understanding this philosophy of cheaper chicken. So here's another one where it can come into play. Let's say you're looking at a condor, which is just two vertical spreads. Let's say you buy the 100 call, sell the 105, sell the 110, and then buy the 115. Let's say it's for a net debit of 2, and that would give us a max gain of 3. All right, so here's what our risk graph would look like. But let's say you're trying to figure out the break-even points over here. All right, so here's our max loss, there's our max gain. What do you suppose this break-even point is over here? Now, sometimes traders can figure it out on the left because it's a call option that we use to build this strategy. But what about the right? They're going, this doesn't look like a call. How do you figure out the break-even point? Go back to cheaper chicken. It's just looking at it from a different perspective. Okay, if we look at this risk graph right there, it looks like a long put, doesn't it? Isn't that the profile for a long put? Pretend it's one. Calls are puts, puts are calls. We've talked about that. This is one of the reasons why. So if you bought the 115 put for 2, what would your break-even point be? Well, you'd have to have it fall 2 points below 115 to 113. So that tells me it should be 113. I can also look at it from the credit side. If I looked at this as a short 110 call, which it is, we've got this unlimited upside. If we short the 110 call for $3, I could afford to have that stock rise 3 points to just break even. So 110 plus 3 should give me 113. So do you see what's happening? I can either take 110 plus 3 or 115 minus 2, and it's going to tell me that the break even is 113. It's all a question of what are the risks you're trying to take, and what are the rewards you're after, and are you trying to hedge risk or hedge the reward? So the thing that I want you to take from this, for a debit spread, you are reducing gains to reduce the cost. You are working with a cheap strategy. If you are using a credit spread, you are reducing gains to reduce risk. And therefore, you are using the chicken strategy. But notice in both cases, you must reduce your gains. It's a question of whether you're reducing cost or reducing risk. So I hope that gives you an interesting insight. And again, I'm sorry for the technological failure there. I don't know what happened, but I hope the rest of this came through. But if you find this helpful, we'd like to invite you to have a free one-on-one consultation with one of our world-class coaches. Phone number is 815-957-9125. Talk about any topic that you want and to see how they can get your trading really in a more focused plan. And that's so much of what this whole thing is about, of having a disciplined approach and staying with that plan. And so if you find these little tune-ups helpful, imagine what a one-on-one coaching session can do. So please give that number a call. Again, it's 815-957-9125. I want to wish everybody a happy weekend, great weekend, and please join us for cocktail hour at 5 p.m. in about 30 minutes, and I'll look for you next week. Thanks so much, everyone.